Accrual versus cash basis accounting. Accrual and cash basis accounting are two primary methods used to recognize revenue and expenses in financial statements. While they both aim to provide an accurate picture of a company's financial health, they differ significantly in their time. Accrual basis accounting. Accrual basis accounting is a method of accounting that recognizes revenue and expenses when they are earned or incurred, regardless of when cash is received or paid out. This means that a company records revenue when it provides a good or service, even if the customer hasn't paid yet. Similarly, it records expenses when they are incurred, even if the company hasn't paid for them yet. Key characteristics. Revenue recognition. Revenue is recognized when it is earned, not when cash is received. This means that a company can report revenue even if it hasn't been paid yet. For example, if a company sells a product on credit, it will recognize the revenue when the product is delivered, not when the customer pays. Expense recognition. Expenses are recognized when they are incurred, not when cash is paid out. This means that a company can report expenses even if it hasn't paid for them yet. For example, if a company receives an invoice for utilities, it will recognize the expense when the utilities are used, not when the bill is paid. Matching principle. The matching principle states that expenses should be recognized in the same period as the revenue they help to generate. For example, if a company spends money on advertising to generate sales, the advertising expense should be recognized in the same period as the sales revenue. Advantages. More accurate financial picture. Accrual basis accounting provides a more accurate picture of a company's financial performance than cash basis accounting, which only recognizes revenue and expenses when cash is received or paid out. Better decision making. Accrual basis accounting can help companies make better decisions about their business operations. For example, a company can use accrual basis accounting to determine its profitability and identify areas where it can improve its operation. Required by most accounting standards. Accrual basis accounting is required by most accounting standards, such as Generally Accepted Accounting Principles, GAAP, and International Financial Reporting Standards, IFRS. Disadvantages. More complex. Accrual basis accounting is more complex than cash basis accounting, as it requires companies to make estimates and judgments about future events. Requires more time and effort. Accrual basis accounting requires more time and effort to implement and maintain than cash basis accounting. Cash basis accounting. Cash basis accounting is a method of accounting that recognizes revenue and expenses when cash is actually received or paid out. It's a simpler approach compared to accrual basis accounting, which recognizes revenue and expenses when they are earned or incurred, regardless of cash flow. Key characteristics. Revenue recognition. Revenue is only recognized when cash is received, regardless of when the goods or services are delivered. Expense recognition. Expenses are only recognized when cash is paid out, regardless of when the expenses were incurred. Advantages. Simplicity. Easier to understand and implement, especially for small businesses with simple transactions. Clear cash flow. Provides a clear picture of a business's cash inflows and outflows. Tax benefits. In some cases, cash basis accounting can offer tax advantages. Disadvantages. Less accurate financial picture. Can distort financial performance, especially for businesses with significant credit sales or long-term projects. Limited decision-making tools. May not provide the necessary information for strategic decision-making. Timing. Records transactions when earned, incurred. Records transactions when cash is received, paid. Complexity. More complex to maintain. Simpler to maintain. Accuracy. Provides a better picture of financial health. Focuses more on actual cash flow. Compliance required for larger businesses. GAAP/IFRS. Typically used by small businesses. Financial reporting. Better for understanding profitability, may not reflect long-term financial health. Which to choose? Accrual accounting. Accrual accounting is better for businesses that need to provide detailed and accurate financial statements to investors, banks, or regulatory bodies. Cash basis accounting. Cash basis accounting is often sufficient for small businesses or sole proprietorships that prioritize tracking immediate cash flow over detailed financial reporting.